thank you for everyone who's taken the time to join us today. I think we have a lot of new faces and a lot of people who probably already know a little bit about AFC, but just to, before we really get into the weeds, I just wanted to share a little bit about who we are and what we do. So the American FinTech Council is a standard-based organization. We represent the largest FinTech companies and innovative banks. Our mission as an organization is to promote a transparent, inclusive, and customer-centric financial system by supporting responsible innovation in financial services and encouraging sound public policy. Our members, like many of the people on our panel today, foster competition in consumer finance, and they pioneer products that better serve the underserved. We have a really great panel lined up for you guys today. I know everyone's very excited about it. Focus on the CFPB and the transition that we can expect, or I guess maybe predict, with the new administration. So they're going to touch a little bit on those leadership shifts, trends in innovation, and the future of rulemaking. We have a really great group, so I will not take any more time away from them. And Susie, I will hand it over to you, and just in doing so, give another thank you to our partners at Husch Blackwell for your constant support.
Yeah, thank you. My name's Susan Seaman. I'm a partner at Husch Blackwell. I'm located in Columbus, Ohio. I have a banking and consumer financial services regulatory practice, which is why I'm involved with this webinar. Husch Blackwell has been an engaged member of the Legal Advisory Committee of AFC since May 2023, I think. Well, that can be fact-checked later. But we really appreciate being able to partner with AFC to present this very timely webinar. So I'm going to have each panelist just give a very quick introduction, and then I'm going to make just a 1 to 2 minute kind of welcome remarks and set the table for our more meaty discussion to follow. So Jonah, do you want to start off, and then whoever wants to jump in after that for introductions?
Sure. Thanks, Susie. Jonah Crane. I'm a partner at the Klaros Group. We're an advisory firm focused entirely on financial services, really the intersection of banking and fintech. So happy to be here today and speculate wildly about the future with you all.
Great. Who wants to go next?
Happy to. Thanks, Susie. Hi, I'm RaShawn Mitchell, and I head government affairs for MoneyLion. Been with the company now for about 4 months, but prior to that, I worked here in DC for the last 16, 17 years, most recently for a bipartisan financial services firm, Rich Fourier Anderson. But I also spent 2, stints on Capitol Hill working for 2 House Democrats, and I worked under the second term of the Obama administration, where I finished up at OMB. Thank you.
Awesome. Mike, you want to go? Oh, you're on mute.
Sorry about that. Mike Silver. I'm at Husch Blackwell with Susie in the DC office, and I came over to Husch Blackwell just about a year ago after 12.5 years at the CFPB. So this is a very exciting topic for me to discuss with you all. I was there about 6 weeks after the founding of the agency, and I worked in the Office of Regulations.
Great. And Ian?
Hey everyone, Ian Moloney. I'm the Senior Vice President and Head of Policy and Regulatory Affairs for American FinTech Council. I'm guessing if you all are here, you might know something about American FinTech Council, but really everything that walks through the door from a policy standpoint, from a regulatory standpoint, of which there are many different issues, they all fall under my remit. So it's been a busy, fast and furious time of me being here. I've been at AFC for about 14 months now, and just expand.
Awesome. Thank you. So I'm going to moderate today's panel. So I'm going to be mainly just facilitating the conversation, but I do want to take just a few minutes to kind of set the stage of what we're going to talk about. So since the election, there's been a lot written, a lot of webinars about the CFPB transition. We wanted to take a kind of more focused view of the transition and talk about really what adjustments could be made to final rules or proposed rules or guidance issued by the CFPB under Director Chopra. How can the new administration that comes in, what adjustments may they make or may they not make, and how would they go about that? So that's really the focus of our discussion today. Before I really take the role of a moderator, I just want to kind of put a thought bubble out there. So before this, to prepare for this webinar, I went back and read a blog post. And you're like, which one? Because Director Chopra made so many. In June of 2022, about rethinking the approach to rulemaking, to regulation. And in that blog post, what Director Chopra advocated for was simple, bright line rules that are clear and are durable, so they would stand the test of time, right? And his arguments for why this is like the gold standard of regulation, where that reduces the barrier to entry for folks, so it fosters competition, it helps us focus on innovation that helps consumers, and it also helps with consistent enforcement of laws, right? So you know, thinking about that blog post and today's discussion and kind of discussion on our prep call, we're going to really be talking about, okay, what happens in the next, 90 days, what happens in the next year when the new leadership takes over, what kind of adjustments may they make to existing rules or proposed rules or guidance. But I think what the new leadership tackles and how they tackle it have longer term implications in terms of the durability of rules and guidance from the CFPB in the future, and how we talk about it and how we advise our clients on it. And I'm sure Ian has already had that thought, but I just wanted to put that thought bubble out there before we start our panel discussion. So with that, a lot has happened in January. Mike, can you kind of just give a very quick highlight of where are we now, what has and has not happened at the CFPB, where are we in the transition?
We are at a moment of profound uncertainty. And I don't mean to sound, hyperbolic, but the fact is that we are 11 days into the Trump administration. And I think as a shock to everybody on this panel, and probably most of, if not all of everyone on the webinar, Director Chopra is still Director Chopra at the CFPB. I think the prevailing wisdom was that he would be fired on day one, based on the Supreme Court decision in 2020 and Celia Law, which made the CFPB director fireable at will by the president, which was not the standard previously under the Dodd-Frank Act. And that's why, if you all recall, former director Richard Cordray stayed on for about 9 or 10 months in 2017 after President Trump first came into office, because there was a different standard back then, and the CFPB director had more protections for being fired only for cause. So everybody expected him to be gone, as well as his senior advisors. Well, lo and behold, there was a pause of about 2 or 3 days where we weren't getting the typical barrage of press releases, blog posts, as Susie mentioned, and other things that really accelerated to a crescendo during the transition. But then it seemed like things sort of started resuming. We've seen reports on a few different issues since then, and he's been giving interviews, basically talking about his record, his legacy, et cetera. So the leadership is very much in flux, and there's a lot of speculation. We don't need to go down the rabbit hole here about why. It does seem like there's a math issue with the composition of the FDIC board, because the CFPB has director typically holds one of those seats. The OCC acting chair, Michael Sue, if you know, is still also in office. So, there are some complexities about, firing them and replacing them and maintaining a bipartisan composition on the FDIC. There's also been public reporting that a lot of notable folks have turned down the opportunity to go to the CFPB, people like the former director, Kathy Kraninger, and others. There also is a complexity related to the Federal Vacancies Act, which dictates who would become the CFPB director if, on an acting basis, if the president fires the CFPB director. It has to be someone already serving in government in a senior position, and there are very few of those folks that were, until there's a lot of Senate confirmations of the new administration. So that will probably be sorted out within the next week or two. Senator Scott told the American Banker a day or two ago there was going to be an imminent announcement of a CFPB director. So again, there's going to be a nominee for a permanent CFPB director that has not been announced yet. and there will need to be an acting director once Chopra is fired. And we have clarity on neither of those points.
I was just waiting for my phone to light up that the news broke right when you were giving us that recap, and we would just take this webinar in a completely different direction. So, but it didn't. So yes, still uncertainty. So this is the third time that the CFPB has gone through a transition since it was created, a presidential transition. Looking back on lessons that we learned from past transitions, what's day-to-day like with folks at the CFPB right now? And what have we learned, again, based on past transitions, how new leadership may approach some of these decisions about reviewing rulemaking or making adjustments to like enforcement priorities and just the change that is to come? Anyone can, Mike, if you want to start the lead, and then anyone can jump in, or if anyone wants to jump in before Mike.
Yeah, I can kick it off. And to the part of your question about what is CFPB staff thinking right now. I know this from being in touch with some close former colleagues of mine. There's a lot of anxiety, but it's not really related specifically to CFPB. It has to do with the other kind of broader executive orders and some of the stuff that was announced this week, where the Office of OPM Personnel Management essentially offered deferred resignations to most of the federal government workforce. And it seems like this is an effort that's sort of an offshoot of the Department of Government Efficiency led by Elon Musk. So there's just a lot of kind of chaos in the sense of people being fearful for the security of their position. There have been other executive orders which would have everyone return to the office 5 days a week. The CFPB has largely been operating with staff remote since COVID. There also are issues around the so-called Schedule F, redesignating a lot of employees who are in policy roles to be not subject to typical civil service protections. So there is a lot of uncertainty, fear, anxiety among the workforce at this point. But again, it's really residual of kind of bigger things happening very quickly under the Trump administration. Now, in terms of lessons learned, I think from a process perspective, and my experience being through several transitions, is that there will be a period, again, once Chopra we think is gone, and then there's an acting director brought in with staff. There will be a period of maybe weeks, if not a few months, where they essentially reevaluate everything on the agenda, the rulemaking, the guidance, all the guidance documents, and the enforcement pending caseload. And there will be a period of time when they go through it and they make decisions about whether to go in a different direction. And we'll talk later in the webinar about what that different direction might look like depending on the type of vehicle.
Anyone else have anything to add about lessons from past transitions, if we can even use those?
I mean, I'm happy to jump in a little bit. And I think, you're quite right, Susie, that there's just not a ton of data points for how the transition functions. And of course, thinking of Celia law, even the last transition is not going to be this transition. And so there's a bit of that, every transition feels a little new and unique still at the Bureau. But I still see some salient features kind of coming across, and that's really that, there's a hyper politicization of CFPB kind of across the board. And, sometimes they stumble upon this issue. Sometimes they seem to relish in the fact that they're, being more politicized than some of the other agencies in the financial services industry. However, that really does have an impact on, I think, who's willing to take that job. And so ultimately, that's where we're seeing a lot of slowing up, just like Mike had mentioned, of a new nominee or anybody that you'd think as your standard folks to kind of come across the line. They're not interested in engaging in that capacity, and so that's where it feels very new. But there are some definite, the politicization is still a very salient feature.
Yeah, and I'll just add to that, to everyone's point. I think once the director is finally in place, I think, obviously they will take a step back to assess what is already kind of on the agenda, well, had been on the agenda, so that they can take a step, see the bigger picture of how to proceed with the new Trump agenda for the agency. But from a more optimistic lens, I think, this new administration has an opportunity to really kind of revisit some of the outdated consumer protection laws that have been in place for several decades now. I think, some clarity around several, innovative technologies that we work with here from a fintech standpoint could certainly be addressed in a way that creates more innovative approaches for our industry. So again, I think we're still, things are tracking along, but I think once things are up and running, there's certainly opportunity there for us to work and collaborate with the new director.
So Jonah, I'm going to start with you with this next question, because I want us all to go around on the panel. But so the beginning of January, there was a flurry of action by the CFPB in the closing weeks of the Biden administration. Did any of the deliverables that came out or actions that happened kind of stick out to you? And what are your overall comments about the CFPB's approach? And I would love for everyone on the panel to kind of quickly go down the line and give your just highlights.
Yeah, I mean, you referred to a flurry. I think others have called it a flood or a mountain or other various analogies. Put some numbers on it. I went back ahead of this and just look back to October 1st, because I thought sort of fourth quarter of last year into the beginning of this year, and there were 6 proposed rules, 4 final rules issued in that time, and no fewer than 20 lawsuits or enforcement actions. And that's just a lot of activity in that span of time. It's not entirely unusual for a bunch of enforcement actions to come at the end of an administration. These things take a while to work their way through. There are often negotiations with the parties, and then a determination is made whether to sue or not. I mean, I think everybody will have their favorite or least favorite, I guess, action over the last several weeks. The big one to, a couple big ones to watch, obviously the 1033 rulemaking, which isn't really part of the last minute push, but was, adopted in the last couple months of last year. I thought the interpretive rule proposal, basically interpreting Reg E to apply to, certain digital wallets and cryptocurrency. I thought that was, crypto wallets. I thought that was really interesting. And of course the larger participant rule. And I think, one reason to think about those is, I think proposals that come from the Bureau that, where industry groups may differ on it, different sectors within financial services may have a different view on it. So, I think banks have long argued that, they want non-banks to be subject to supervision by the Bureau as well. So, our banks, I think large banks, or at least large banks, are supportive of the larger participant rule that the CFPB proposed. And so it'll be interesting to see how the Bureau responds to those. The first Trump administration was supportive of consumer data access. They included it in a Treasury report early on non-banks, and were favorably disposed towards it. So it'll be interesting to see how they deal with that one. And caught up in all this, of course, is Elon Musk is getting into financial services now through X. So we'll have to see if he weighs in on CFPB policy any further.
Great. RaShawn, do you want to give your kind of quick takes about the, I don't know, fill in the blank of what happened in January?
Sure. Yes, I totally agree. There was certainly a mountain of action that I think many of us weren't quite anticipating, although there is, history of an outgoing administration to have some action here. But I think the thing that stood out most for me, and I think we'll touch on it a little later in the conversation, but the CFPB's assertion that earned wage access products should fall under the Truth in Lending Act and be treated as credit. Kind of claiming that these products are create debt obligation. They also pointed out some flaws in the original rules, legal reasoning, which many of us in the industry kind of confused, to say the least. So definitely happy to dig into those impacts later in the conversation, but I think that's the one that stood out to me most this month.
Mike?
Yeah, I'm picking up on Jonah, what you said about like what's the right descriptor. I mean, I'm fond of using like pretentious SAT words. I mean, it's like a blitzkrieg, a maelstrom, like it's just whatever a deluge, like it's just been an absolute like immense amount in volume and velocity of just stuff. And you listed out, the most formal of them, the proposed rules and final rules. I mean, now there just been report after report, blog posts, the so-called compendium of recent guidance. And we'll talk more about, what's going to happen with sort of the non-notice and comment rule stuff. It was a 363-page document itemizing 42 separate deliverables of non-rulemaking guidance. So I mean, that I think illustrates like some of the issue here. And I'm really glad, Susie, you brought up the blog post where Chopra signaled the desire to go in this direction, to try to move away from notice and comment rulemaking and the objective of trying to provide clear and durable guidance. I mean, I think preaching to the choir here, I have serious doubts that most of the 42 tabs and the 363 pages are either durable or clear. I say that. I mean, I worked on some of that guidance, and I think I do think some of it is more valid than others, and my hope is that whoever is the new leadership would go through it with a scalpel and not a chainsaw and try to evaluate it. But in terms of like, if I had to pick one, Susie probably knows which one I'm going to pick because, I've made some other public statements about this, but the no action letter revised policy, which, in a sense is, I mean, I would call it a no action letter policy because it's really seems designed to discourage applications rather than encourage them. And I mean, the thing that's gotten the most publicity, at least in social media, at least within inside baseball circles, is the lifetime ban on people like me, former CFPB attorneys, from representing companies who want to apply for NOWs. I think that provision is both ill-intentioned and somewhat offensive, and it's also, I think, offensive to current CFPB staff. Implying that they need extra ethical protection. Because they're so easily swayed by someone like me. But I think that's really the shiny object. There are so many things in that new policy that are kind of non-starters for anybody who would think about applying for a no action letter. Like, for example, why would a startup company ever want to voluntarily consent to CFPB supervision as a condition of getting the approval? And the fact is that it's only a 2-year set amount of approval period, whereas under the prior policy, it was more facts and circumstance dependent. And just the process, I mean, it didn't go through notice and comment. It was like 11 days before the inauguration. The program has been basically dormant anyway for 2 years based on Chopra's decision to retire some of those policies. So why would they all of a sudden out of left field sort of re-release this with all these conditions? It just seemed very odd from both a policy and a positioning perspective, in addition to, sort of offensive to me personally.
I felt like I was grabbing my coffee to just hear like thank you, Mike. Yeah, that was a good one to call out. And Ian, any particular action that pointed out that really caught your eye, and just general comments about the CFPB's approach in the closing months or weeks?
Yeah, definitely.
Felt like months.
It felt like years, honestly. I took it as while we were experiencing the deluge, or whatever adjective we want to choose to describe this. It was whatever could get in the way of my holidays. So that was ultimately, I think, what I took away from it is let's destroy Ian's Christmas and New Year's and whatnot. But I don't hold anything personal on that front. So but I think really like between the three other esteemed panelists, they really hit everything that was on my notes of, this stood out to me, whether it was the no action letter, the compliance assistance sandbox, those policy statements. And I think, Mike, you astutely really, framed it up, and it is something that was completely confusing, surprising. It was not on my bingo card whatsoever that they were going to take on this 2-year-old, essentially retired policy, and they had already signaled that they were shifting away from this. Whether it was the general counsel Seth Frontman or the director himself, like they were not interested in kind of going this path, and then to do sort of a left turn. And then similarly, I mean, RaShawn, I think you brought up around the proposed rule, the interpretive rule, and that was one aspect. But then to go ahead and rescind the 2020 advisory opinion in the 11th hour, that was another situation where it's, I think both of those really spoke to something that I kind of saw across as far as the agency's plays as it got closer and closer to the election. They were feeling pretty bullish. And then after the election, it did not swing the way that I think probably the director, if I had to make some assumptions, wanted it to go. And then it started to seem very haphazard, very political, ultimately. And there was clearly a focus on, we have to get these things across the line to preserve a legacy, as opposed to, we need to create durable rulemaking or something that could stand the test of time. And I recognize, from a political standpoint, they were already within the CRA window. That kicked off August 1st, roughly, of last year. But at the same time, there is a benefit to still kind of going through that process. And it was interesting that they were even continuing to propose rulemakings, such as, the FCRA proposed rulemaking. I mean, those sorts of activities, it just became, the closer and closer we got to the inauguration, the more political that the messaging was, and the more focused on just getting something across the line became. So it was kind of a little disheartening, I'll say.
Great. Thank you all. So before we go into, which existing regulations, proposed or final, or guidance may be adjusted, or what may happen to what we have on our plate, let's just quickly recap. Okay, what are kind of the vehicles through which rules and guidance can be delayed or unwound, whether within the CFPB or another body? What are the different options out there? If it's just a quick recap, Ian or Mike, I don't know who wants to go first, but feel free to jump in.
I mean, I'm happy to kick things off, Mike, and you can fill it in, as I know you will. For the how things are going to look, as far as what the look back procedures are, what the process is, it really depends upon what was the activity conducted by the Bureau. So, like, starting out at the very bottom, because we know that the director liked to issue some blog posts, and that was potentially market moving, a little more informal guidance, or probably the least formal guidance that I can think of. Those technically had no binding quality to them, and they stand in that regard, and they can be just with a new blog post, we have a new viewpoint, or essentially, like, once Chopra walks out the door, so do all of the views that he and Seth Frontman, or some of the other folks that were part of the the higher ups at the agency, those walk out the door with them. Then you have things like your policy statements, your guidance documents, your interpretive rules, things like that, and those can be adjusted pretty much with a flick of a pen. I mean, not to be terse, but essentially, if it's proposed and never finalized as far as an interpretive rule, then it never held any true weight. Now, there's the perceived weight, the de facto weight, but no actual formal quality to it. So with that, then essentially, there's nothing necessarily proactive that an agency has to do to kind of rescind that perspective. If it had been finalized, there are activities they might have to just issue a new interpretive guidance or interpretive rule, a new advisory opinion, things like that. Then we get to the big, the legislative rulemakings, and those, if they're proposed, you can continue to keep them proposed, and just kind of the same rules apply for the informal. But then the formal rulemakings, that's where the Congressional Review Act comes into play. And as I noted earlier, you've got the window that started for a look back. Roughly August 1st, since the look back is predicated on 60 continuous business days of the Congress. That's when they can look back, and so that hit us roughly to August 1st, I think. And so that's where, on the legislative side, there's going to be a lot of activity, and already, we're hearing rumblings of folks on House Financial Services, the committees of jurisdiction, and then Senate Banking as well, focused on what are their items that they're looking at really engaging with first and focusing on, because they do have a limited amount of time to engage.
Yeah, and Ian, that's a really good recitation of the different categories of deliverables and how potentially the new leadership will address them. Just to add a few fine points on top of that, it is the case that for what we're referring to as guidance, so basically something that is, I'd say, semi-formal but not as formal as a notice and comment legislative rule. So things like advisory opinions, interpretive rules, circulars, which is a sort of vehicle that the CFPB invented a couple of years ago, policy statements of policy. Those are kind of, and I think like we did a webinar, Susie and I, and I think Ian, you were on it as well, about 10 months ago, where Susie had this like awesome chart that kind of like had like showed the different categories of this type of guidance, where the stuff on the left is like more formal, the stuff on the right is less formal. And I think that taxonomy in a sense, dictates the response. So, there is precedent like early in 2021 for the CFPB publishing a Federal Register notice to rescind guidance that was issued under the Kraninger administration. So the abusiveness policy statement from 2020 was quickly revoked in early 2021. And then, of course, Chopra, under his direction, the agency issued a new and much longer and more expansive abusiveness policy statement in 2023. So that's the type of thing where I would expect new leadership, presumably, to publish a notice to potentially revoke that. There's a question, of course, it's a policy question of whether that's really good for industry or consumers to kind of have this ping pong effect where each administration, depending on their point of view, puts out guidance reflecting their view and their prerogatives, and then that's pulled back by the next administration. It creates this, vacillation, which leads to a vacuum and makes it difficult for compliance. For notice and comment rules, you alluded to, or someone alluded to the FCRA data broker proposal. As a proposal that's out there, there's a regulation AA proposal that they released during the transition, which basically would recreate the old FTC credit practices rule and expand it to include things like unilateral changes in credit contracts. So it would be a pretty expansive proposal. But then, of course, there are all the final rules, some of which were mentioned earlier, 1033, the 1071 data collection, the LP rule, which Jonah mentioned. So the outcome of those proposals and final rules, I think, will be dependent on different factors. One of which will be, do they want to stand up a new rulemaking process to revoke the final rule? Because they would have to do that under the Administrative Procedure Act. That's what happened with the payday lending rule that I worked on in 2017. It was released under Director Cordray, but then when he left, Mick Mulvaney and then Kathy Kraninger decided to go in a different direction. But they had to stand up a new rulemaking team and a new rulemaking process to actually revoke a portion of the 2017 rule. And of course, on the back end, that means that revocation rule can be challenged in court by folks who were in favor of the original rule. So I think that's a point I wanted to make to illustrate that this process is for final rules is very messy and unwieldy and could lead to outcomes that maybe are idiosyncratic because anytime you stand up a new rulemaking process, you have to subject it to public comment and notice, and there's potential litigation on the back end from other stakeholders who are going to argue that the agency did not have a reasoned basis for going in that different direction. But then, of course, Ian mentioned, I think, the Congressional Review Act. It's possible, I would say a small number of the final rules would be subject to CRA. That's dependent on timing, floor time, prioritization in the Senate in particular. And then the last factor, I think, is litigation. Because as most, if not all, of the CFPB's recently issued final rules have been challenged in court by various stakeholders, and they're going through the district courts and courts of appeals. And depending on judicial decisions, but also whether the agency under new leadership decides to keep defending the rule, or whether they decide to change their position. Again, this happened in 2017 on the payday rule. Part of that process was when the trade groups for the payday lenders sued the agency. Under new leadership, the agency agreed to jointly seek a stay of that litigation pending doing a new rulemaking. So this is another decision point that new leadership, whenever they're in place, will be on their plate as to how to proceed in the ongoing litigation for some of these final rules.
Okay, awesome. Thank you, guys. Jonah and RaShawn, do you have anything to add, or do you want to move on to the next discussion point?
I think Mike and Ian crushed it. Yeah, I don't have much to add to that.
No,
Jonah?
I mean, just a footnote, maybe. I mean, one thing we don't really have a good feel for right now is how some of the recent Supreme Court decisions, Loper, Bright, among them, are going to, impact how courts, look at agencies in particular when they, adopt new policies or, change, do a 180 on policies, shortly after issuing, rule or guidance. And I think that'll be an interesting thing to watch, and probably take a while to play out. And I doubt we'll get a ton of clarity about how courts think about that, and I suspect different courts will come to different conclusions there. But I think that series of Supreme Court decisions sort of hangs over a lot of this activity, and then questions around not just the calendar in Congress, which is looking increasingly jammed, but their appetite for weighing in here. I think it's an open question to me anyway, whether Congress really wants to vote on the overdraft rule, for example. That's one that's often been cited as being potentially vulnerable to a CRA challenge, and it may well be, but that's not the easiest vote in the world for members of Congress to take. So I think when the new leadership is in place, there will be a process by which they look at all these things and say, okay, how are we going to tackle them? And at some level, one has to assume that Chopra's strategy was to make that as hard as possible by making the list as long as possible.
And that was Jonah, that was a great segue into the next question, which, we have this, as you mentioned, volume of rules and guidance. There could be competing interests in what kind of gets addressed first. Ian and RaShawn, how can AFC and others help with this review prioritization process, both with Congress and the CFPB, and kind of sort how do we tackle this? What are some effective ways to kind of advocate for the industry?
I mean, I'm happy to chat first on this one, RaShawn, if you want. I think kind of comically, like this is a full Ian Employment Act. Like I'm very happily employed and doing this day-to-day work. Essentially, it comes down to really getting in early and often to not only the legislative offices, that are really key, whether it's the committee chairs or the subcommittee chairs, and kind of getting your views out there, but also speaking with leadership kind of writ large, and also recognizing what all is on the agenda. I mean, there is a long list of potentially CRA-able activities, but that doesn't just include CFPB. That includes other agencies as well. And so, it's good to always kind of keep a very realistic approach about where you fit in sort of the food chain. And, I mean, whether you're dealing with provisions in Tax Cuts and Jobs Act, or you're looking at changing things around medical debt, like you have to always think about yourself in that broader context. And then that's where kind of that concurrent strategy around going to regulators and engaging with the incoming leadership, but also the career staff, because just because they're a career staffer doesn't mean that they hold the views, and actually can be quite the opposite case, where they do not hold the views of the political folks that have been in power and are looking to engage in a more substantive conversation and actually pursue whether it's proactively looking at additional rulemaking, or kind of reforming, putting a new imprimatur upon an existing rule, or also doing things to rescind or react and re-engage with the topic. I mean, there's really kind of that dual strategy that has to be taken. And then I guess if there were a third part, engaging with really the folks that are impacted kind of on the ground, and making sure that if you have consumers, if you're engaging with them, and this issue impacts them, understanding what their stories are and really hitting on that, because that makes kind of those other two strategies really impactful when you have consumer stories. So RaShawn, I'm sure you've got tons of other thoughts as well, so I'll kick it to you.
No, thanks, Dan. I think you really nailed it. I'll just add to the fact that, there are so many new members of Congress, especially those who fall within like the House Financial Services and Senate banking committees, and they're still in process of even hiring their staff. So, being able to go in, right now, Congress is really focused on some of the key political issues that, the administration ran on, whether it's immigration or debt reconciliation. So as those conversations are taking place at a very high level, us going in and introducing ourselves, and taking in white papers and really sitting down to introduce ourselves to be a resource to these offices as they begin to staff up and figure out what their key priorities will be for this Congress. I think something to also take note of is the fact that there are several House members who have already announced or are looking potentially to run for a statewide office in the coming year or two. So I think leveraging our relationships now with them as they move on to potentially run for governor or other offices, that they have a better understanding of what our industry priorities are, so that they can take that education with them along their professional journeys. And I also think it's important to note that I think there are a few areas where, believe it or not, this Congress is looking to legislate bipartisan solutions to issues. Data privacy was something that has been discussed for quite some time, as far as getting a bill across the finish line. Obviously, the House has very thin margins right now, and then the Senate, obviously, they're focused a lot on nominations process right now. So again, as far as what order they're going to tackle things once they kind of get through the immigration and the debt reconciliation process, I think in the meantime, Ian and others within the industry, we can kind of go in and really, do some proactive education for these offices to help bring them up to speed for when our issues are actually on the table.
Awesome. I think this next discussion point is going to be pretty meaty, so I want to allow enough time for it. So under Director Chopra, the CFPB issued final and proposed regulations and guidance that were focused on innovative products. We had the 1033 rule come out. We had a proposed advisory opinion for EWA. We had a not proposed rule for buy now, pay later. And we already saw earlier this month that the CFPB rescinded the November 2020 EWA advisory opinion, right? So we already see kind of movement and change, and that was under the Biden administration. So my next question for everyone to jump in on, but maybe Jonah, you could start us out, is what impact could this unwinding or adjustment to existing regulation and guidance that we have on our plate have on innovative products in the future? What's kind of the short and long-term impact of any adjustments that the CFPB makes to existing guidance and regulation?
Sure. Well, I'm sure, like RaShawn will have a very on the ground perspective on this, and, love to hear what he has to say. I think, the industry, companies engaged in, innovative activities, offering innovative new products are often struggling a little bit between wanting some clarity from the regulators, but not wanting to be too boxed in. Products often don't fit really well in, under traditional regulatory frameworks. They, sit somewhere across different regulatory regimes or in a bit of a gray space. And so that's complicated to deal with. I think, my general expectation is on something like EWA, the states were already very active. And so even if the new administration, rescinds the more recent EWA guidance, the states will continue to be active there. And so I think, it could actually be helpful if the new administration were to try and take up some of these innovative products and provide, more of a nuanced, tailored framework for them. It's a tall order, and I don't want to, undersell that. But I do think my basic expectation is that, the states will be active here in the absence, at least some states will be active in the absence of sort of clearer bureau direction on that. And it makes it very difficult, I think, to navigate for companies in that space.
Yeah, and
Anyone?
just
Yeah, they're good.
right, go ahead.
Oh, no, RaShawn, I was just gonna open it up to other comments.
No, yeah, I think Jonah really nailed it. At least from a MoneyLion standpoint, distinction really matters when it pertains to EWA. Treating it as a credit product versus, it creates, I think, more problems than it solves. Kind of how what I touched on earlier, we're an industry where, we were quite confused by some of the decisions that came out of the end of the Biden administration, kind of forcing providers to, follow credit or loan regulations might, have unintentional consequences where, we're treated as traditional lenders, right? And so getting that sort of clarity from this incoming administration would do a great deal as far as, again, advancing innovation and helping companies like ourselves, kind of bridge the gap for the consumers where they obviously need additional options to make better financial decisions. So again, EWA is designed to offer those flexibilities, right? And so how do we empower our consumers without clear direction from the CFPB and switch back and forth between different administrations? So whether that comes from a clear authority from the CFPB or whether that comes through congressional action on Capitol Hill, we had a bill introduced last year where we're trying to, build some more bipartisan support for that. Again, I think, I'm still optimistic that there could be opportunities there as we, again, do some of our proactive outreach on the Hill. So again, EWA is something that we're certainly going to continue to press the incoming administration on to make decisions that are transparent and benefits both industry and the consumer while not putting this round I guess object into a square peg.
Yeah, I agree, RaShawn. I mean, absolutely. I think the EWA issue just sort of cries out for some sort of more permanent approach, whether it's at the regulatory level or the legislative level. I mean, it's a hybrid state and federal issue at this point. The CFPB's approach has been patchwork at best, and in fact, I don't know if you all feel the same way, but I kind of struggle to follow the import and impact of the final deliverable on EWA, because again, like thinking about it from that lens of like the continuum of administrative law vehicles and what it all means from an authoritativeness perspective. So basically what they did was there was an advisory opinion from 2020 as well as an approval under their former innovation program that spoke to certain types of EWA products that had certain types of conditions that the CFPB felt meant that they were not considered credit and essentially were acceptable. They had this very sweeping proposal last summer that would have not only kind of revoked that advisory opinion and the logic behind it, but gone much further in terms of their interpretations under TILA and Reg Z of what debt means, what credit means, and how EWA products, both employer-based and direct-to-consumer, would fit within that framework. that of course got a lot of comments, including from, members of this group. But then they issued this whatever thing, revocation of an advisory opinion that was not a final interpretive rule. It wasn't a finalization of the thing from last summer. And in fact, it only obliquely discussed the thing from last summer. And instead, they just revoked the 2020 advisory opinion based on some arguments about, flaws in the legal reasoning. So it sort of just begs the question, well, what is the state of the law in the eyes of the CFPB at this moment? Even, and again, I'm not even accounting for change in leadership and whether new leadership would just have a different view here. It's not even clear what the view of current leadership is. To say that we revoked this sort of narrow 2020 advisory opinion, but then you have all this stuff sort of hanging out there in the Federal Register about how do you really feel, CFPB? Well, you can look at the July 2024 proposed interpretive rule. So like, is that really how their view of the law, or is the current document the view of the law? I think that kind of speaks to this broader question of a pivot and approach towards innovation. I mean, obviously, it's not a surprise, I'm sure, given my impassioned remarks about the new NOW policy that I very much hope and think that new leadership would revive some variation of the Kraninger era innovation policies. I think that they were both good for industry and good for the agency, because they opened up another tool choice that had really been quiescent under Cordray in terms of engaging with companies, both startups and more established companies, to really grapple with questions where the regulations or the statutes were ambiguous and they didn't, it wasn't clear how they would apply to the products and services that were emerging. And, as someone who was, practicing as in the regulations office for many years, I mean, for something like RESPA, Section 8, I mean, it is just very obvious that the statutes are, aged and, sort of need to be modernized. And it's very hard to understand how they would translate to, modern day technology and product development. And so I think under the Kraninger era, there was sort of a recognition of that fact, and they were using the innovation program in part as a tool to alleviate that. And of course, the current leadership really just had a different philosophical approach, and they really thought it was almost improper for individual companies to interact with the Bureau. And frankly, I think had a premise that it wasn't ambiguity driving that interaction, but rather regulatory arbitrage. So I definitely think that new leadership will go in a different direction, and hopefully out of all of this can come out some clear and durable policies for the Bureau.
Any reactions to that?
I mean, I'll just quickly say that I think that all the other panelists have really hit this topic quite well, and that these two, whether it's EWA or BNPL, they really represent, in my mind, sort of a microcosm of how the agency has chosen to pursue its informal rulemaking. And so when you have the just straight to finalization interpretive rule for BNPL, which recognizing there's different product qualities to earned wage access and BNPL. And so it's not surprising that they're kind of treated differently from a regulatory standpoint, in the process world. But you have that on BNPL, and then you have a proposed interpretive rule that was never finalized. You have that rescinding of the AO from 2020, which essentially leaves there's a fair amount of certainty, though people may disagree with how much they enjoy that certainty on the BNPL side. I think that there's a complete lack of certainty around the Bureau's actual, what would be a defensible position if somebody were to say, well, what is the actual formal opinion of the Bureau? At this point, we have very speculative and politically driven views of what the Bureau's perspective is on EWA. We have that less so with BNPL. And so I think it's very interesting to kind of watch the two processes and how they unfolded. And both still, I think, somewhat politically motivated, but very different in outcome.
If you saw me like clenching my jaw, it's because I was biting my tongue on some of the decisions and interpretations made with some of those rules. So I want to skip one of the questions and go to states. State law, I love state law. So how do we see the regulation and guidance that was issued under from the CFPB under Director Chopra influencing states' regulatory priorities going forward? One thing that strikes me is even if we have these, these proposed interpretive rules, they're still out there. There's still a perspective that was shared, and others, they can influence others, right, at the state level. And I think that that's a cautionary tale of, the negative side of proposed guidance, right? The perspective's still out there, even if it's not finalized. But I just like to hear Jonah and everyone on the panel how you see that body of guidance that we still have in those regulations influencing state players going forward.
I'll be super brief because we're coming up on time. I mean, historically, i.e. the last Trump administration, the only historical analog we have, states really stepped in, states really stepped in when they perceived, the CFPB as stepping back from an enforcement perspective. And the Bureau, of course, has recently basically encouraged states to take up its own interpretation of consumer protection laws, and other panelists can talk in more detail about that. But that's, I would expect that trend to resurface. We've already seen it start, not in an enforcement way, but with the New York DFS, proposing limits on overdraft. It seems like the states picking up the mantle is already underway.
RaShawn, do you want to share your quick thoughts?
Yeah, well, I might defer to Ian, given he's been out
Yeah.
more than I have. But I agree. I think, it's important that, our message isn't that we want this administration, the incoming administration, to roll everything back, because states will pick up the slack where they feel the federal government isn't stepping in. We've seen a flurry of hearings already to kick off this month here in January. So, Ian, I might hand it over to you, since you've been kind of more on the ground than I have thus far.
Yeah, no worries, RaShawn. I think you're quite right, and Jonah, you're 100% correct around the state engagement, and state sessions are already crazy as far as their activity because they are so short, and some don't even occur every year. And so, we've seen a flurry of activity. I know, this week we're actually in, I think, 7 or 8 states testifying, and whether it's in person or remotely on various issues. And I think, innovation was naturally, those issues were going to come up naturally within the state houses because, think about AI, thinking about earned wage access and other issues, those were gaining in prominence anyways. However, now with, I think, the move away, or perceived move away from really a proactive regulatory agenda at the federal level, certain states, and they can be easily listed or thought of, California and New York, are going to be trying to step into that void, and with the full force of the director of CFPB, Rohit Chopra, and the general counsel Seth Frontman really pushing that through their recent publications on the state consumer protection roadmap. So that's kind of what we're seeing on the ground.
Yeah, just to cap, I was going to make the point that Ian, you just made right at the end, which is don't sleep on the current top leadership of the CFPB continuing to promote these policies and their agenda. This was signaled very strongly in the executive summary of the compendium on guidance, where they basically made and to Jonah's point, they made this very interesting attempt to try to claim that under Loper Bright, they were actually, we believe that the interpretations set forth in these documents reflect the best reading of federal consumer finance laws. They are anticipating that the new leadership will want to go in the opposite direction, and they're essentially trying to future-proof these interpretations and encourage, states or plaintiffs to use these interpretations and try to get deference or interpretations, validated by the courts down the road. And of course, they had the separate concurrent report, as you alluded to, Ian, where they basically are shopping model state laws on how to prohibit junk fees and on abusive practices. So this is a very different approach than we saw under any other transition. In the past, I think it was kind of a more passive situation where, you know, there'd be an administration change and the states would kind of fill the void, and you wouldn't have the deposed or prior leadership sort of continuing to affirmatively push that agenda. But that's what it seems to be happening now. So it's definitely something to keep an eye on.
So read the 42 tab document for tonight. It's tonight's homework. All right. Thank you all so much for joining this webinar. I thoroughly enjoyed the discussion. I hope audience did too. And yeah, we'll see what happens. Maybe there's an alert on our phone. We should go check. So thank you all. Have a good afternoon.